Yo, what's good, niggas? What's good, my G's? Alright, welcome to another K9 video. Alright, so we're back again, live in business. Okay, so today we are going to be starting the week off with some fair value gaps. Okay, alright, so or imbalance, whatever you want to call it. I don't care, but fair value gaps. Alright, so we're going to look at what they are, how we can apply them into the market, and why we apply them into the market. Okay, that's what we're going to be looking at today. So let's get into it. So now, what is a fair value gap? Okay, so a fair value gap is basically a price range where there are no conflicting orders. Okay, so I'm when I mean no conflicting orders, that is, there's a point where it just buys all through. Right, there's just buys all through, and then maybe there's also a point where there's just sells. Okay, that is no conflicting order. All right, understand? So like that you guys, I'm sure you guys maybe have seen, obviously, if you have been trading for long, you would have seen maybe some imbalances. You would have seen some big moves to the upside, all right, or big moves to the downside, like those sudden boom, maybe like because of news or whatnot. You'll see some sudden moves to the upside, like boom, and then there's just this massive candle to the upside and to the downside that just pours out its load, on the market. Okay, so like those are called imbalances or fair value gaps. Okay, so there's a space between them. All right, so when you're talking about the bullish fair value gap, yeah, it's a three candlestick pattern. All right, the fair value gap is a three candlestick pattern that starts from the so for the bullish, it will start from the first candle all the way to the third candle, and then there's a candle in between. Okay, so the first candle for the bullish, it will start from the top of the first candle all the way to the bottom of the third candle. All right, so that space in between, all right, that is your fair value gap. And don't worry, you are going to see some practical, you know, explanations on it in part 2 and part 3. Okay, so like I was saying, fair value gaps, okay, exist between for the bullish, it exists from the top of the first candle all the way to the bottom of the third candle. Now for the bearish candle, okay, for bearish candle, it exists from the bottom. Okay, I said bearish candle. For the bearish move, that's when it's going to the downside, it exists from the bottom of the what it exists from the bottom of the first candle all the way to the top of the third candle. All right, so that's how it moves. Okay, so and then those places are where price can come in, because the market doesn't like imbalances. Okay, it doesn't like voids. Okay, so the market tries, from what I've observed most of the times, market always tries to fill in the gaps. Okay, so it doesn't like to leave any gap unattended to, so that is a comfortable range for price to retrace back into that position or that price point, in order for it to get more orders filled, and then rally the market into the direction that it wants to continue going in. So for instance, like I said, market doesn't like imbalances, doesn't like spaces, so it tries to fill them up. So that's a pretty good price range for price to continue, or for price to push itself. Okay, so it gets into there, gets more orders filled. All right, you know the like being able to fill in their massive orders through that. So it's the fair value gap is also a retracement tool. Okay, so like the liquidity sweep and the break of structure, those ones are the main. They're like the main building blocks. Then we have the retracement tools that we're going to be looking at. Okay, so I finished the first part, which is liquidity sweep and break of structure. So I finished that part. We now understand what those are. Alright, if you don't understand them, rewatch them. Okay, you're going to see them over there. Alright, so then I was saying that the market will come back into that price range in order to fill in more orders to be able to push market into the direction that it was going to go initially. Okay, so fair value gaps, they are very very much essential, right? Because you can use it as a retracement. Now there's a difference between retracement and reversal. Retracement is that it is still going in the direction, in its previous direction, or its previous dominant direction. Okay, the reversal is that it's completely changing the dynamic. That is, if it was a bearish trend, now we are moving over to a bullish trend. Obviously the market doesn't move straight. Okay, market is like up down up down up down and going in a particular direction. Okay, not that it's ranging is different, it's just consolidating, right? Staying in one whole level, which the support and resistance traders will be using, to take their trades. But you know when the market is changing their trend, that is a reversal. When it's simply just retracing or pulling back to be able to move or continue moving in its original trend, or it's in its original decision that it's moving towards, okay, that is a retrace. Alright, so hopefully we're seeing the difference between the two right now. So that's how it works. Now I already explained almost everything about fair value gaps and what you need to know about imbalances. So obviously you want to use that, okay? You want to use that to know that, oh, okay, so since I know that this is where the market is targeting, okay, or this is where the market is going. Now there's now that imbalance, there's that void, there's that space, okay, where there were no contradicting orders. So wouldn't it be smart for us to know that, okay, price is obviously going to come back into this place to get their orders filled in more, right? To be able to have enough momentum to push price into the direction that they wanted to go to. Alright, we're trying to think, remember, we're trying to always think like the casino. We're always trying to think positive. Oh, sorry. Yes, we're also trying to think positive, but we're trying to think like the casino, we're trying to think like the market movers, okay? We don't know when they press their sell button and their buy button, but we can pretty much get a close range accuracy between what they're doing and what we are doing. Okay, so that is actually what the process of fair value gaps is. Alright, so you the it's a retracement tool, like I earlier said and stated. Okay, so you want to use that as a retracement tool, and in the coming videos you will be able to see how that applies, how that works, how you can use it, in trading. And for the most part, the upcoming videos on the remaining building blocks are literally going to be more specific or specified or toned down into the the what do they call it now, into the retracement tools. Okay, so look more, the ones that are coming will be more into retracement, and the ones that are already done, which is liquidity sweep and break of structure, those are like the main, I like to call them the main. And then the fair value gaps, order block, and equilibrium are just like retracement tools. So retracement tools meaning that you cannot obviously just take a trade off of, oh, I see a fair value gap, oh, I see another block, oh, I see an equilibrium. No. Okay, so you start to converge all these guys together, start to model them up together, start to mix them up together to be able to take a trade. Alright, so that is pretty much it for this video, and not much anymore. That's literally all I have to say. Okay, so I'll see you guys in the next one. I thank you for joining me on this episode again. If you vibe with me, just click that subscribe button. Okay, and also I will be looking forward to possibly doing another challenge. Okay, so I think right now, as of now, we have only one challenge day. Possibly I'll look for another challenge to do. Alright, so yeah, that's it, boys. I'll catch you guys in the next one. Thank you very much for tuning in. I'll see you guys later. Peace out, guys.